In this video, I'll be going over Work Together, Problem 13-2 on calculating profitability measures. This is from page 384 of our Century 21 accounting textbook, Advanced, edition 11 by Gilbertson and Lehman. So credit to them for this text and this problem. All right, so we are taking information from KL Marketing Group's financial statements, and we are going to calculate some ratios about profitability. Okay, rounding to the nearest 0.1% and dollars to the nearest cent. First thing, gross margin. Gross margin is your current year gross profit minus, divided by, my bad, your net sales, which is right here below it. Okay, so 61.9%. Prior year, 64%. All I had to do is drag that across to get those same formulas, right? Okay, called autofill, I believe. Okay, operating margin. This is calculated as R equals income from operations, and we'll take divided by net sales, and that is 9.3% current year, autofill over 8.5% for our prior year. Next one, rate earned on average total assets. All right, so we have beginning assets, and we will add, so plus our ending assets. Okay, we'll have to divide that by 2, which means order of operations, we had better use parentheses, and that'll give us our average total assets. All right, so let's put that whole amount in a second set of parentheses, because we've got to divide by our average total assets. And we do net income divided by average total assets. So net income divided by our average total assets here, enter. 9.2%. And we'll carry that over. It was 8% prior year. Now let's do rate earned on average total stockholders' equity. Here again, we've got to find our average on our stockholders' equity. So we'll just start with our 2 parentheses because we learned beginning stockholders' equity plus ending stockholders' equity. And then we'll divide that by 2 because that'll give us the average. Okay. And then we're going to just do net income divided by that amount. 14.5% this year, and last year was 12.8%. All right, last one, free cash flow. Formula for that is your cash flow from operating activities, and we'll do minus our capital expenditures. So if you were doing this, for real from like your whole set of financial statements, it was going to be a little more complicated because some of these would be on your income statement, some of them would be on your balance sheet or your statement of stockholders' equity or your cash flow statement. But here, they're all nice and easy for you on this problem. So let's figure out favorable result, favorable trend. Gross margin. Last year we were at last year 64 down to 61. We want to be between 53 and 60. So this one is outside of the target range. So that's not a favorable result, right? And is it a good trend though? Because we went down by, 2.1% towards the high. So towards the target, it is a favorable trend. We're headed in the right direction. All right, operating margin, we want to be between 8 and 10%. Last year we were at 8.5%. This year we're at 9.3%. So we are still right in the middle of that target range, so that is a favorable result. And we are closer to the middle of that range this year than we were last year. We headed towards the middle point of the target range, right? So we'll say that that's also a favorable trend. Rate earned on average total assets. So we want to be between 8.5 and 9.5. Last year we were not. We were too low. But this year we're right there at 9.2, which is within the target range. So we'll say that that's both a favorable trend and a favorable result. Rate earned on average total stockholders' equity. We want to be between 10.5 and 18.5%. Last year we were at 12.8, still within the range. This year we're at 14.5, even closer to the midpoint of this range. So that is favorable. We're in range and it's headed in the right direction. Free cash flows. All right, between 46.5 and 49 is where we want to be. Last year we were at 47. This year we're at 46,900. We are just barely above the low end of the target range. So is it a favorable result? Yes. But we are not trending in a good direction, right? We went from the middle of this, up the 47,000 mark, down to just barely above the low end. So we are not really headed in a good direction. If that continues, next year we'll be outside of range. So that would be a no. Finally, explain what its operating margin from the current year tells the marketing group. What can we learn from this operating margin? Well, last year we were at 8.5%, and this year we are at 9.3%, right? Which means that our income is higher than it was before, because the income from operations is your numerator. So that would be a good thing. So what do we really know? From this number, we know that 9.3% means that every dollar of sales, they earn 9.3 cents of net income, right? And we know that that number was bigger than last year. So I guess all we really need to say is for every dollar of sales, the marketing group earns 9.3 cents of net income. More specifically, from operations. Okay? And that it's better than the previous year. So this was Work Together 13.2. And the On Your Own here is on the other tab. And you can do that one on your own.